Have you ever wondered about the equation that changed the financial industry? This isn't just any equation. It's the one that laid the foundation of 4 multi-trillion-dollar industries. It's a remarkable story, and it all started with physics, a discipline far removed from the world of finance. And yet, it was the understanding of physics principles that paved the way for a paradigm shift in how we perceive risk in the financial market. You see, this equation doesn't just come from the realm of finance. It has its roots in the fundamental laws of the universe. It's derived from the same principles that led to the discovery of atoms, the understanding of heat transfer, and even the strategy to beat the house at blackjack. It's a surprising connection, isn't it? That the same principles governing the natural world could be applied to the unpredictable and often volatile world of finance. Indeed, this equation is so powerful, it enabled physicists, scientists, and mathematicians to outperform veteran traders in the stock market. It's a testament to the fact that understanding the underlying principles of how things work can give you an edge, even in the most unlikely of arenas. And this isn't just a theoretical concept. This equation has been put to the test, and it has proven its worth. It's the secret behind the success of one man, Jim Simons, who outperformed the market average by 66% annually for 30 years. Yes, you heard that right, 30 years. It's an incredible feat, one that has made Jim Simons one of the richest mathematicians in the world. So buckle up as we delve into the story of this groundbreaking equation, its origins, its applications, and its incredible impact on the financial world. We'll be exploring how it changed the game for investors and traders, and how it continues to shape the financial landscape to this day. This equation is the secret behind the success of one man, Jim Simons, who outperformed the market average by 66% annually for 30 years. Once a mathematics professor, Jim Simons founded the Medallion Investment Fund in 1988. Simons was not your average Wall Street honcho. He was a code breaker during the Vietnam War and a brilliant mathematician who in the late 70s decided to apply his knack for numbers to the world of finance. Simons began his journey in the financial world by establishing a hedge fund, which he named Renaissance Technologies. But it's the Medallion Fund, a fund within the firm, that turned out to be the golden egg. It was a fund that was initially available only to the employees of Renaissance Technologies. Simons and his team of mathematicians and scientists employed complex mathematical models to identify and exploit inefficiencies in the market. The Medallion Fund was wildly successful. So successful, in fact, that it outperformed the market average by 66% annually for 30 years. This consistent, extraordinary performance turned the fund into a legend of Wall Street. To put this into perspective, if you had invested $100 in the Medallion Fund in 1988, it would be worth a staggering $8.4 billion today. Yes, you heard that right. This unprecedented success made Simons the richest mathematician in the world, a title that is as fascinating as it is unique. While many may argue that mathematics and finance are two different beasts, Simons managed to bridge the gap, proving that numbers in the right hands can indeed turn into gold. But it wasn't just about being good at math. Simons had a unique approach to investing. He relied on quantitative models and algorithms to make investment decisions. This approach, often known as quantitative investing, involves using advanced mathematical models to identify profitable opportunities in the market. It's a method that requires a deep understanding of both mathematics and financial markets. Simons' success was largely due to his ability to leverage his mathematical expertise to understand the complexities of the financial market. He understood that the market was not a random walk, but a complex system that can be understood and even predicted with the right mathematical tools. However, it's important to note that being good at math doesn't always ensure success in the financial market. Just ask Isaac Newton, one of the most brilliant mathematicians and scientists of all time, who lost a fortune in the stock market. But that, my friends, is a story for another day. But being good at math doesn't always ensure success in the financial market, as we can see from the story of Isaac Newton. So while we marvel at the genius and success of Jim Simons, let's remember that the world of finance is a tricky beast, one that requires not just mathematical prowess, but also a deep understanding of markets and human behavior. The story of Jim Simons serves as a testament to the power of mathematics, but also as a cautionary tale about the complexities and unpredictability of financial markets. Isaac Newton, master of the Royal Mint and a Cambridge professor, was rich with a wealth of £30,000. Our tale begins in the year 1720. Newton, at the ripe age of 77, was financially well off. His primary source of income, apart from his prestigious professorship at Cambridge, was his position as master of the Royal Mint. These roles combined gave him a wealth equivalent to $6 million today. Newton, like many others at the time, was drawn to the allure of the stock market. He set his eyes on a company that seemed to promise great returns, the South Sea Company. This was a company heavily involved in the transshipment of African slaves across the Atlantic. With business booming, the value of its shares rose significantly. Newton bought stocks, and by April of 1720, his shares had doubled in value. Seeing the profits, he sold his stocks. Yet, the prices kept rising, and Newton, unable to resist the potential for further gains, bought back in June. He kept buying shares, even as they reached their peak. However, the bubble burst, and the stock prices began to plummet. Newton, believing he could buy the decline and make a profit, acquired even more shares. He held on to them, hoping for a rebound. Unfortunately, it never came. The result was catastrophic. Newton saw over a third of his wealth vanish into thin air. The man who could calculate the motions of heavenly bodies, who understood the universal laws of physics, found himself at a loss when it came to the unpredictability of the stock market. Newton's story serves as a stark reminder that even the most brilliant minds can fall prey to the volatility and unpredictability of financial markets. It's an illustration of the human factor in economics, the madness of people that can drive markets to dizzying heights and devastating lows. Newton admitted, "I can calculate the motions of the heavenly bodies, but not the madness of people." Then, there was Louis Bachelier, who pioneered financial market modeling with math. He was born in the year 1870, and life dealt him an early blow when both of his parents passed away when he was just 18. This unfortunate turn of events compelled him to take over his father's wine business. But a few years down the line, he sold the business and moved to Paris with dreams of studying physics. However, supporting his family was a priority, and he found a job at the Bourse, the French stock market. The Bourse was a whirlwind of activity, with hundreds of vendors shouting prices and striking deals. It was here that Bachelier was introduced to the madness of people that Newton had spoken of. But rather than being overwhelmed, Bachelier was fascinated, particularly by option contracts. Option contracts, which can be traced back to 600 BC, when the Greek philosopher Thales of Miletus executed the first call option, intrigued Bachelier. These contracts offered a way to predict the rise or fall of market prices. A call option, for instance, gives you the right, but not the obligation, to buy a particular asset at a predetermined price at a later date. A put option, on the other hand, gives you the right to sell. Bachelier was captivated by the potential of these options and began to study them intently. He realized that math could model the financial markets, just as it could the physical world. He started working on the theory of speculation, which was a pioneering work in the field of financial mathematics. His doctoral thesis, The Theory of Speculation, was the first to model the financial markets mathematically and introduced the concept of Brownian motion to finance. Bachelier's work was way ahead of its time, and it was only much later, in the middle of the 20th century, that his thesis was rediscovered. His innovative approach to option pricing laid the groundwork for the Black-Scholes-Merton model, which is widely used in the financial markets today. This model, which was developed almost 70 years after Bachelier's thesis, earned its creators the Nobel Prize in Economics in 1997. Bachelier's contributions to financial market modeling were groundbreaking. His work opened the door to a new way of understanding and predicting market behavior. Today, his theories form the backbone of modern financial mathematics, and his influence can be seen in the multi-trillion-dollar industries of options trading, financial derivatives, and risk management. Option contracts, which date back to 600 BC, became a key component in the financial market. They allowed traders to hedge their bets, to speculate on future price movements, and to profit from market volatility. And Bachelier, with his mathematical models, brought a new level of sophistication to their understanding and use. His work transformed the financial markets and forever changed the way we perceive risk and reward. A call option gives you the right, but not the obligation to buy something at a strike price later. This is a concept that has been used in financial markets for centuries, but it's not always easy to understand. Let's imagine a scenario to help decipher it. Suppose you have a keen eye on a tech giant stock. Let's call it Peach Inc. Their stock is currently priced at $100 a share. You have a strong hunch that Peach Inc. is about to launch a groundbreaking product, and this will send their stock soaring. However, you don't want to put all your money down right away. This is where a call option comes into play. You decide to purchase a call option for Peach Inc. with a strike price of $100, valid for a year. This option costs $10. Now, the beauty of a call option is that it gives you the choice to buy the stock at the strike price within the contract's time frame, but it doesn't obligate you to do so. Fast forward to a year later, and your prediction was spot on. Peach Inc. launched an innovative product that revolutionized the industry, and their stock price skyrocketed to $150. You can now execute your call option, buy the stock at the strike price of $100, and immediately sell it at the current market price of $150. After subtracting the cost of the call option, you've made a profit of $40 per share. On the flip side, let's say your prediction didn't pan out. Peach Inc.'s product launch was a flop, and the stock price plummeted to $70. Since you're not obligated to buy the stock at the strike price, you can choose not to exercise your call option. In this case, your loss is limited to the $10 you spend on the call option. Now let's shift gears and talk about put options. A put option offers you the right but not the obligation to sell something at a strike price later. This can be particularly beneficial if you predict a price drop. Imagine you own shares in Peach Inc., and you suspect their stock price might fall. You could purchase a put option with a strike price of $100. If the stock price indeed falls to $70 within your contract's time frame, you can exercise your put option. This allows you to sell your shares at the higher strike price rather than the lower market price, thus cushioning your losses. If the stock price doesn't fall as you expected and instead rises, you can simply choose not to exercise your put option. Again, your loss in this scenario would be limited to the cost of the put option. In both these scenarios, call and put options serve as a kind of insurance policy, helping you manage potential risks while providing the opportunity for substantial profits. However, it's crucial to remember that these options also come with their own risk. The cost of the option could turn into a loss if the market doesn't move in your favor. In conclusion, call and put options are strategic financial tools that allow investors to hedge against potential losses and capitalize on market movements. They offer the flexibility to buy or sell at a predetermined price, providing a safety net against market volatility. These options have become powerful tools in the financial market, thanks to the equation. The equation that created trillions of dollars in industries was a game changer in the financial market. It has been a fascinating journey, hasn't it? Let's take a moment to reflect on the key points we have discussed. We journeyed through the story of Jim Simons, the mathematics professor who founded the Medallion Investment Fund. His fund outperformed the market average by 66% annually for 3 decades, turning a $100 investment in 1988 into an astounding $8.4 billion today. Simons, leveraging the power of this equation, became the wealthiest mathematician in history. Contrastingly, we explored the downfall of Isaac Newton, a brilliant mind who, despite his mathematical prowess, lost over a third of his wealth in the financial market. He heavily invested in the South Sea Company, failing to sell when prices fell and subsequently buying into the decline. Newton's experience reminds us that arithmetic strength alone doesn't guarantee success in the financial market. We also delved into the life of Louis Bachelier, the man who pioneered financial market modeling with mathematics. Forced to run his father's wine business at a young age, Bachelier later sold it to study physics in Paris. His exposure to the bourse, a raw display of market dynamics, intrigued him, leading him to explore the potential of option contracts. Lastly, we gained a better understanding of call and put options, financial instruments that offer the right but not the obligation to buy or sell at a predetermined price. These options, born out of the first option executed by the Greek philosopher Thales of Miletus in 600 BC, continue to play a significant role in our financial markets today. This equation continues to influence the financial industry, shaping our understanding of risk and the dynamics of the stock market. It's a testament to the power of mathematics and its ability to transform industries and fortunes alike.